Get this dude's wife on stream instead, he says. She's a much better investor, he says. Well, you might not be terribly wrong. So my wife, unfortunately, is a little bit more private than I am, but probably not unfortunately, but I will share in this video what our combined portfolios look like. I'm not going to share the direct values. I'm sure some of you math wizards out there might be able to divisively figure it out based on my portfolio, but there's some severe overlap, so it'll probably skew those numbers just to keep her privacy welcome. But she's been bragging to me about her meta position that I sold out of at 220, and I took good profits at 220, but she rode that sucker all the way down to 90 and all the way up to where it sits today. And we're going to break some of this down as we first and foremost review my portfolio, where the accounts sit ending this week. We'll take a look at the combined portfolios and then review what's been going on with earnings. And if that is a conversation you'd appreciate, damn it, hit that like button, because it's been one hell of a start to the year. Now, like my wife, we were a little bit more actively involved in our portfolios during market insanity, when we were speculating a lot heavier on the likes of MindMed and stocks like Tesla when they were just ballooning to absurd levels. So it made sense for us to be a little bit more actively involved, because it saved us a heck of a lot of downside, and we locked in a lot of profit between us with some of those massive trades. But we've kind of come to the conclusion, and at the scale of our portfolios, that we're looking for long-term sustainable investments. Though we do have some speculations, we've kind of boxed them away, pretend like they don't exist, like our crypto and stuff like that, and we're just presuming those lottery tickets go to zero. We're not trading as actively as we used to, as I'm sure you've seen on the last couple of years of this channel, as we've transitioned more into the ETF realm of things. But we are looking to take on some speculative risk with some individual companies, which you'll see in the combined portfolios, because it's been greatly working to our favor, right? Like, we see value in these companies, this transition to robotics and AI. And I said, until my job is replaced by AI, my car is driving itself, and there's robots walking around, we have not reached parity with how far tech still has to come. We are in the early days of this massive growth and margin expansion that, yeah, you could say they're expensive, there's going to be volatility, but come back to me in 10 or 15 years and tell me buying companies like Google and Tesla were a mistake. Could be wrong. You might be able to rub it in my face, but we're using ETFs to kind of back up our glorious speculations. But in the individual accounts this week, as I continue to build up my tax-free savings account, we can see that, yeah, I'm still up nicely, and I'm glad. And this is why I said I really wanted to go super aggressive before earnings on Google. Obviously, Meta would have been the better decision, but as mentioned, we own Meta. We'll see that in the combined portfolios in a moment. But yeah, I went heavy on Meta here at around an average price of 140. We'll see what the shares look like in the corporate account, and I'm still up. Every time Meta dips below, or Google dips below 140, it seems to be getting bought up here. I think I got a good price. I said that if it dips below 140, probably closer to the 120s, I would be more inclined to continue to accumulate here. And same with Tesla. Like, I don't want to be buying these above my starter prices. I'm very much hoping Tesla goes back below 180, and I'll be able to continue to accumulate at lower prices. I just like picking up the dips when they're major, because they tend to get rallies after the fact, right? So the TFSA doing pretty nicely for the first of the year. I mean, look at the S&P since we just loaded up at the beginning of the year. We're up 4% already, which, by the way, the S&P's up a whopping 4% this month. It's almost jaw-dropping. It's staggering. SCHD has just been holding flat nicely, reinvesting the dividends. Nothing crazy. I just did a video on SCHD. I love this ETF for the diversity. I still think there's going to be a recovery on the interest rate cut cycle to a lot of companies that are in here. But honestly, just for the compounded dividend growth, you know, just having this as kind of a base to diversify away from tech is also a helpful thing for our portfolios. But in the corporate account, this is where most of the gains have been going on, because I just relentlessly went into the S&P in here, especially when the market was down at the October lows. I mean, you guys gotta go back and watch those videos, and I was telling you, man, just to gobble up when stocks are getting hit hard, especially when the S&P drops by 10% or more, you just gotta take advantage, because then when we get these kind of days, I mean, we're up 19% now, 13,000 US dollars, and we've got Google in here at an average price of around 141. These were the last bit of shares that I bought, and like I said, I'm not inclined to be buying Google at this point unless we get some severe dip. So that's just kind of my primary portfolios, excluding speculations, gold, and things that I got stacked up or laying around the house as other asset values. But really, the combined portfolio has some more intriguing, insight to it to kind of give you a way of understanding my decision making. Now, we have a lot of investments, and I've been trying to core focus these investments so we're getting the best performance out of our portfolios, because we can see both of us have invested pretty heavily in the S&P 500. It makes up about 41% of the combined portfolios, and SCHD is at about 21%. But we have other ETFs in here like IEFA. I think there are some mutual funds sitting in the other of 8%, and VDY as well. If I had to run the math, 70 to 75% of the entirety of our portfolio is sitting in ETFs. Very comfortable, very happy with that. And a little bit of Canadian diversification is like the smallest amount, because between VDY and some of the banks and stuff, which I'm still looking to buy this month before bank earnings come around. I want to make the Canadian markets a relatively small position as more or less part of the dividend income side of the portfolio. But our fixation and our focus continues to be on the tech sectors. Now, this hasn't been updated after the 20% rally in Meta, so do keep that in mind that Meta's a substantial position, especially when you consider the weightings we have in the S&P 500, which I was debating on doing that in this video, maybe in another video. I'll do a weighting breakdown because people don't realize there's a lot of overlap between these ETFs. So because we own Meta, we have to take into consideration that Meta is a massive position in the S&P 500 by another percent or two, which would raise the overall weighting probably closer to 5 or 6%, I believe, especially with Google here. So we're not really looking to add to these positions as much because they're so big. With Microsoft and Apple being a bit smaller here, we have some Accenture stock, Tesla's in here since I started accumulating at Amazon, some Johnson & Johnson, really small weighted. I wish we had a little bit more Amazon as well. But the goal here is to keep building out the tech positions while also consistently adding to obviously these other positions, so we constantly get a nice equal weighting in a division. But for our current ages, we're both the same age at 31 years old here, and we've got a nice amount within this piece of real estate that we bought. I feel as though we're in a very privileged position and we've worked very hard for this. And we're both very frugal, thank God. I mean, this has gotten to where it's gotten to because both of us, we live lives that we'd prefer to spend money on, travel being our only real luxury. And we pretty much avoid anything else, cars, all that. We both don't have any debt. We're really kind of following the Dave Ramsey lifestyle and just trying to fast track the mortgage and get it paid off early. But hopefully this gives you a little bit more clerical insight into kind of how we've balanced these portfolios. And again, I think this is, for our age, a very healthy place to be for the level of risk we're taking on here. Now, taking a look at the broader markets here to kind of give an idea of focus, I really do think the Canadian banks are still trading at discounted levels. And I realized that, either we were kind of decision making that, I think the wife should perhaps sell off her individual banks and put it in an equal weight bank ETF, or honestly, because she already owns, Canadian Imperial Bank and Bank of Nova Scotia and TD, that I could just probably weight the other ones like Royal Bank, perhaps BMO, National Bank, and we can just divvy it up that way without actually having to put our money into a ETF. Because I know I like the Horizons Equal Weight Bank ETF, but that'll start accumulating fees, whereas I could really easily just buy 2 or 3 of these at a low cost and just let them sit there for a while, right? But the Canadian markets have not been that entertaining over the last week, but we're not quite into a full-blown earnings season yet. But that's been the Canadian market story for the last little while, whereas on the U.S. side of the market, we get this insanity. I mean, NVIDIA somehow doesn't stop running, and they have a lot of expectations to keep up to this quarter, so all eyes are going to be on NVIDIA earnings, but we can really see that Google kind of got hit after its earnings, whereas Meta kind of took the reins this time around. And Apple, I feel so bad for Apple because I think there's some huge potential, and I'm really hoping the stock continues to decline because it is one that I would like to accumulate when people think it's kind of done and out with at a much better value. Like if it was trading at Google's value closer to that 25 times multiple, I would be way, way more inclined. But yeah, this earnings season, I think, only really offered a bump to Meta and Amazon. I think they took control of this earnings season, and it was definitely well deserved, whereas the rest of the market is slowly starting to trickle back up, which gave us that real performance this week in the S&P 500. I mean, to see a 4% bump at the beginning of the year in VOO is just almost 5% is absolutely insane for an ETF at this scale. I mean, could you imagine you get 4 or 5% every month? I mean, it's super unlikely, it's super unsustainable, but it really just goes to show you, with the Magnificent Seven and these upper weighted stocks really propelling this, that, these companies are truly making waves, and I think those waves are going to continue. So we're going to be doing a video very shortly here, and we'll be expanding it on my Sunday night live stream as well when it comes to things like Pepsi, Enbridge, some of these more dividend payers, as we'll review their earnings that obviously weren't nearly as insane as the tech earnings that we just went through. But yeah, buckle up because we're still just getting into it, especially when it comes to the Canadian side of the border. And I'll pass the question off to you. I'd love to know what you think about our portfolios, where we kind of stand on our path to financial independence to perhaps one day retire early, which if you're on that journey, consider subscribing and following. Sometimes I'll be nutty, sometimes I'll make some mistakes, but at least I'm being transparent, and it's going to be fascinating to see how all this unfolds.